rate increases, mortgage stress tests, Bank of Canada. You hear all these terms tossed around in the news. It's front and center in most media today. Today we're going to dive into what it all means. We're going to look at mortgages and financing and how it all affects your ability to purchase a home.
Hi guys, I'm Sharayah and this is my husband Mark. We're a real estate duo based in Gander, Newfoundland, and we're here to provide you your weekly key to property prosperity. We would love it if you rang the notification bell, subscribe to our channel, and follow along as we release new videos every week to provide you value as you navigate your own real estate journey.
So first we want to talk about understanding mortgage rates. In Canada, mortgage rates vary greatly and they're influenced by factors such as the Bank of Canada's prime rate, the economy, and each individual lender's own policies. So there's a couple things to keep an eye on. There's fixed rates and variable rates. Here in Canada, mortgages are based generally on a 25-year amortization. That's the full length of the mortgage. But here in Canada, like I said, you're given what's called a mortgage term, where you have a term of between 1 and 5 years generally, with a set agreement with a bank or lender that sets your interest rate for that 1 to 5 year term. So like I said, we have two different types. There's generally a fixed, where the mortgage rate stays the same for that 1 to 5 year term, or a variable rate, which is just that. It varies based on those factors throughout the course of that 1 to 5 year term. It's an interesting fact that our neighbors to the south in the States, generally they have a fixed rate mortgage for the full amortization period of 25 years, which worked out great for some people when the interest rates were so low. But that's it in a nutshell. So that means here in Canada, over the course of a 25-year mortgage, you're going to renegotiate your interest rate based on current conditions at least 5 times, assuming you go with a 5-year term over the course of 25 years.
Yeah, and before we even start looking at rates to see if that's even relevant to our own situation, we want to look at the next thing, which is the importance of credit score. So one crucial aspect that affects your mortgage rate is your credit score. And lenders use this to evaluate your credit worthiness. So the higher your credit score, the better chances you have of securing a lower interest rate. Of course, now credit score also comes into play with even getting approved for a mortgage. But then once you are approved, again, it can affect your actual rate itself. So one tip is to remember to check your credit score regularly. If you're thinking, hey, I want to buy a house, whether it be, in the next 6 months or in the next couple of years, check your credit score regularly, see if there are any issues, and if there are any issues, fix them before applying for a mortgage. So this will help with your pre-approval process and your financing when you come to that point. We'll add some links in our description so that if you haven't checked your credit score before, you can follow those links and do so.
The next thing, there's a couple I want to consider, is the down payment and some of the other expenses that are to come with that purchase. So in Canada, the minimum down payment on your first home is 5% for the first $500,000 of the home's purchase price, and then 10% for any amount over $500,000. If your down payment is less than 20%, you'll also need to get mortgage insurance through a provider like CMHC, the Canadian Mortgage Housing Corporation. And essentially, this insurance protects the lender. In case you don't pay them, the lender will still get paid on the mortgage.
Yeah, and I want to just clarify when Mark said that the down payment is 5% that's required for your first home. It's for your primary home, right? So we're saying first home, we don't mean okay, so if you sell that home and then you go buy another home, that next home, it's still 5% down payment. The thing that we want to talk about with how it relates to financing is the pre-approval process. So if you've talked to a realtor before, they may have asked you, have you been pre-approved? If you're really new into the whole home buying process, this might be something you're like, I don't even know what you're saying. But the pre-approval process is before you actually start shopping for a home, is consider getting pre-approved for a mortgage. So, if you were going to the store and you're going to pay cash for something, you're not going to go and just show up at the counter and be like, I have no idea if I have enough cash to pay for this object. You want to know that you have the right amount of money for the product that you're going to purchase. Same thing when it goes to buying a house. So this involves a lender reviewing your financial situation and determining how much money that they're willing to lend you. So it's a valuable step that not only helps you understand your budget, but also makes you more attractive in the eyes of sellers. So if there's, say, for example, if there's multiple offers going in on a home, or maybe your conditions aren't as favorable to the sellers, then if they say, hey, well, this is a pre-approved buyer, then they may be more inclined to consider your offer. So the pre-approval process can give you an understanding of how much home you can afford, and this is based on factors like income, expenses, and credit scores.
Yeah, and I'll just add a little thing to that. If you have been pre-approved and you're looking at purchasing, this is not the time to make additional purchases.
Yes.
Don't go buy a car. Don't go get a new credit card. Yeah. These things can take your pre-approval and toss it out the window because you've, again, as Sharayah mentioned, you've changed those factors, the expenses and your credit score.
Yeah, absolutely.
So we just spoke about the pre-approval. If you have a pre-approval, that's great. Now it's time to shop around for the best deal. Okay, so say you went to your bank where you have your debit card, you've had it there your whole life, they give you a pre-approval for a mortgage and a rate of 5%. That's fantastic. Congratulations, you've been pre-approved. Chances are, if that bank is willing to pre-approve you, so are a number of other banks, and they're probably going to be willing to compete for your business. And this is where a mortgage broker can come in. They'll take your financial information and they'll shop it out to a bunch of different financial institutions and lenders, ultimately trying to get the best rate for you. So you can take your time here, explore different options, and find a mortgage that aligns best with your financial goals, and of course, find the best deal.
Yeah, absolutely. Everybody loves a good deal. In conclusion, knowledge is power when it comes to making one of the most significant financial decisions of your life. The market and rates are ever changing, so get in touch with one of us if you want to purchase a house and you want to discuss the appropriate timeline for you and what that looks like for your financial situation. Again, guys, if you have any comments, questions, concerns, or if you found this video helpful, hit the thumbs up button, leave us a comment. We're here to provide you value, and we look forward to chatting with you again next week.
See you then.